Happy Wednesday, chameleons. And there's my favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Good. We'll get right with the disclaimer. What do you think?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's the disclaimer.
And we've got another Q&A day planned, correct?
Yep. So I think we'll continue. Today with the Q&A. You know, we've been getting some good questions coming in. People have come on live, talked about some of the things that they've been seeing in the market, some of their trade setups, any kind of question you have using a Market Chameleon tool. You know, you could come in there and ask it either in the chat, if it's kind of an easy, short question. If it's a more involved question with other surrounding circumstances, Will's putting a link there that you could click on that will take you over to Zoom. When you're on Zoom, there's a button there, lets you raise your hand. This signals to Will that you're ready to come on live. You don't have to turn on your video camera, but we'll be able to hear your voice. And this way you could ask the question. We could all hear the question. We could ask you about any of the surrounding circumstances. And sometimes it helps a visual to point to what you're looking at. That's always helpful, because when a lot of times when you point to what you're looking at, it clears up the question a lot, you know, because then we're seeing, okay, now I'm seeing all the different variables around your question, and we could focus in on it better. And I think, answer that question more appropriately. So again, either in the live chat, you could put it in, or click over to Zoom and ask that question over Zoom. While we're waiting for questions to queue up, I'm going to just take a quick look on the pre-market report. And I always have some backup questions that I get through either emails, chats, conversations. I'm going to default to those until we get a live question coming in. Okay. Again, this is really for the benefit of the community, because I do believe that the best way to learn trading is to learn from experiences, learn lessons. It could be costly lessons, mistakes, but as long as there are takeaways, then you're doing better in trading, right? As long as you have takeaways and you're learning lessons and you're making tweaks and adjustments, then you're just gambling. So the whole point of it is that if you've experienced it, probably somebody else experienced it. If you see something unusual, somebody else will see it as an unusual type of circumstances, and we could bring it up. If I don't have the answer, at least maybe somebody else has the answer, or somebody else sees it. But that's, the idea behind, the Q&A. So let me share my screen real quick. We'll start out with the pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm coming down here really quickly to see how many made our percentage gainers list. And I see 101 stocks on the percentage gainers list, 41 stocks on the percentage decliners list. So from that perspective, it looks like a more bullish bias at the open. I'm going to take this market cap filter, see if the same thing is happening in the higher market cap stocks. So using the market cap filter, let's look for stocks 20 billion or higher. And let me just see here. I think I might have to refresh my screen real quick. It might be stale here. So I'm going to refresh my screen. Let's go look at stocks 20 billion market cap or higher. So here we see 21 on a percentage gainers list, 12 on a percentage decliners list. Not a huge list, but does favor a bullish bias at the open, slightly bullish bias at the open. While we're waiting for the questions to pop in, Will, maybe I'll just start on some of the recent emails that I've been getting, because I have been, piling up some questions as backup. Unless you have somebody right away, let me know, Will. If not, I'm going to start.
Nothing's popped up yet.
Okay. So a couple good questions came up actually, and it has to do with when you're trying. A lot of people look at analytics and try to match it up with other websites. So I get this all the time. I get websites and people send me links and say, why doesn't, this match up with this website, or you're not matching up with that website? And it has to do with data cleanup. Okay. So when we're talking about data, right, you get this raw data. And anybody hear about cleaning the data and tagging the data, right? And I'll give you an example. So this question came up. I had two questions actually. One is, why doesn't the open, high, low, close match up with, websites like Yahoo Finance or NASDAQ? Or, why doesn't your average volume match up with like Yahoo, or they give me different websites, Bloomberg, whatever. So first, let me explain to you about what I mean by data cleanup and tagging, okay? Sometimes people say, well, let's say I'm looking for home sales. I want to know, how many homes sold, right? And you might just say, well, just give me everybody's number should match up, right? This is the number of homes sold. This is the average price. But one thing is what you want to do and how you're analyzing the data, right? Because within that, there's lots of things that could be going on, right? You might want to know, split it off, how many new home sales versus used homes, right? New home sales versus used. How many condos versus single family homes? How many commercial versus... So what happens is you get this aggregate, but then the picture could look a lot different once you start breaking down the data, okay? The other thing is data. Whenever you're dealing with data, there's a cleanup process because there are flaws, there are exceptions, and then sometimes even with real data, and real information, it's how you treat it. So I'll give you an example. Let's say I want to look at a neighborhood, and in that neighborhood, I'm interested to know how many homes sold in this neighborhood and what is the average price, right? That's what I want to know. So, of course, I could take let's say two or three houses sold, and I take the two or three houses that sold, and I took the average price, and I'm like, okay, here's the average price. It's, $150,000, right? But what am I actually looking for? And I have to go and look at the data and see, am I treating it correctly? Did 3 houses sell, and is the actual average price 150? So then let's say I take a look at the data and I say, look, this transaction looks weird to me because I see a house. Let's say a developer bought a house that was distressed for $100,000. He fixed it up and sold it for $200,000. Okay. So you're following me? 2 transactions. Developer buys something that's distressed, dilapidated, whatever, very cheap, fixes it up, sells it for $200,000. So what am I trying to do when I'm looking at the data? If I'm trying to figure out, so there's 2 transactions. So do I treat that as 2 transactions or 1, right? Because if I'm trying to find out how many end products, right, like people demand for houses out there, I may want to just treat that as 1 transaction because the developer didn't intend to live in the house. He didn't buy it for himself, right? He saw an opportunity, picked it up, flipped it to the end user, right? So there's a question of volume. Is it really, 2 transactions or 1? Did 2 houses sell? Because if I treat that as 2 and compare it to the previous year, where maybe 1 house sold to an end user, it looks like there's a big increase in volume, right? So let's say last year, same time, only 1 house sold for 200,000. All of a sudden, 2 houses sold for 150. So there's an increase in volume, right? But a decrease in price. So that's number one question you have to ask yourself. The next one is, well, what is the real average price? Is it 150? Is that what the price you want to use? Or is it 200, right? Because the 100,000, again, that was based on some, sale, to a developer because it was dilapidated. You have to fix it up. But at the end, let's say 2 houses sold for 200,000 that were already in good condition, right? Livable, occupancy condition. And this is the problem when you're dealing with data, okay? It's what are you trying to analyze? What are you looking at the data, and how do you want to treat it? And this is anytime you work with data, anytime you're dealing with an analysis, especially huge volumes of data, right? Huge volumes of data like we do in stocks and options. It's your cleanup process. It's your methodology of treating that, how you want to treat that data. So if my intent was to see in this situation, what is the average price an end user is buying, where's the real market? Where's the actual real market of houses? I might exclude that 100,000 sale, right? Because unless there's a bunch of other ones that I could buy, I might exclude that. And as a developer, I might want to see, like, if I build a new house, what am I expected to sell, right? If I'm just going to take land, buy it, build a new house, is it 200,000 or is the market 150,000? That's why when, I don't know how other websites start treating data, right? Or how they clean up the data or what methodology they use. I have no idea. I'm not responsible for those. They're taking raw data and they're doing their own. And we have our own methodology from our experience. So the caveat is, yes, when you start seeing data aggregated, even volume, right? Volume, implied volatility, even reference prices, we might have it differently because it's what we think people are using the data for that matters. And are we going to take out outliers? Yes. Are we going to sometimes smooth out the data with averages? Yes, because we're kind of trying to get the essence of where things are trading, where stocks are going. So if you don't have any questions, well, I'll start giving some examples. But if you do have questions, I could get back to that.
Yeah, we did have one question earlier, right? It was a type in, and it was from Albert. He was asking about, let me go to it. He was asking about the day's decay. The question, does Theta decay literally one day at a time? Is the question. Adjustments being done before the open when they post the price at the opening print, 9:30.
So wait, say that again.
He's wondering how Theta actually decays. Is it something that's literally decays one day at a time? I think it's constantly decaying.
It's
right?
It's constantly decaying, and on top of that, you have implied volatility is changing, right? So when you think about Theta, right? Theta is a theoretical number. It's a theoretical number created by a model. All right. There's no way to say that this is the way the option is going to behave exactly, because there's other variables as the market's moving. It's changing, right? A theta is a theoretical number saying that based on the information right now, with nothing changing, the price doesn't change, the time doesn't change, the implied volatility doesn't change, your interest rate, dividend, nothing changes. Based on if I freeze everything and I use the Black-Scholes model, accepting all the assumptions of the Black-Scholes, right? I'm not going to get into that, but you have to also accept assumptions that Black-Scholes makes, okay? These aren't like, when we're talking about assumptions, you're saying that I'm guessing this is how things work, right? This is my best guess. So if you plug it in, you get this theta number saying that, well, at this point in time, theoretically, if nothing else changes by the end of the day, the stock price doesn't change, nothing changes, everything is exactly the same, and the Black-Scholes is correct, then this option will decay by this much today. That's what you're saying, okay? As soon as something changes, you got to recalculate it. So it's giving you a general sense of your risk. Okay, that's what you're trying to do, is get a general sense. Because otherwise you don't know, right? So you need to use a model to get a general sense of what am I expecting to decay here? Am I like $2,000 a day, $1,000 a day, or $10,000 a day? So in reality, it doesn't really matter if it's $2,010 a day or $1,950. What you're trying to do is get a general sense, like how much approximate risk do I have on here, right? Is it $100 or $2,000 or $10,000? That's kind of what the model is doing, because you're working with estimates and assumptions, okay? But it's the best thing you have is a model to give you a general sense of your risk, all right? So I think some people mix up what a model is and estimates. What they think something is concrete and they're going to see exactly what the model is spitting out. And that's not the case, right? The case is that you're trying to freeze it in time and get a general sense of approximately what is my risk here, right? If all the, given the variables that I'm seeing, approximately what is my risk? Does that make sense? Does that help answer the question?
Albert, was that helpful for you? Just let us know. Obviously, there's a little bit of a delay between the two.
Right.
Yeah, no, Albert says thanks.
Right. So remember, as time is going on, everything is changing, right? Everything. So from at 9:31, right, you're not going to have, and then you fast forward at 10 a.m., the variables have changed. There's less time in the day. The stock price probably moved. Implied volatility has moved. All this stuff changed. And then you're recalculating your risk at that moment, right? So that's what's happening. At that moment, you're recalculating your risk. So let's assume you start out even with a small decay, right? In the beginning of the day, if implied volatility moves up in your position, now you have the same position on, but the options went up a lot, right? Well, the model is going to tell you now you're decaying even faster because now the options are worth more and you might want to take some options off, right? You're like, well, whoa, now I'll take off some profits because, I don't want to decay this much and I'll take off some profits. But the idea is that you're using a model to get a general sense of what are your risks, right? Based on assumptions. So we're dealing with estimates, you're dealing with really financial models or estimates. Okay.
Perfect.
Okay. Any other questions?
Nope, that was it.
Okay. So the question, I had a few questions with data. One is looking at volume, one is looking at open, high, low, close. So let me take the first one is open, high, low, close. And when we look at the opening price of a stock, right, everybody believes, okay, there's an opening price. So why do we reference an opening price? The opening price because we could calculate volatility, or we could see how much did the stock move from the opening price, or where would I be able to hedge my position at the open? The problem with opening price, and let me start showing you something here. This is how the opening price works. The opening price is based on the listing exchange, which could be like, say, New York Stock Exchange, right? Takes this order book that he has, then determines, well, how much stocks for sale, how much is for buy, how much does he want to do in inventory? He comes up with a price and then says, this is the price I opened it. So here's the problem with that. Let's go to August 31st. I'm going to show you what we do. First, let me show you the opening. Why am I seeing it here? Opening. So this is what it would look like. You get these are opening crosses, right? See New York Stock Exchange opening crosses. And what will happen is, like, let's say over here, 2,860 shares open at $330.27. After that opening price, right? So the opening price does not work the same way as regular trading. So regular trading is you have a firm bid and a firm ask, that you could trade on, right? So you could hit the bid, you could hit the ask, you could place, things in between. The opening price doesn't happen that way. The opening price is like, you don't even know where it's going to open until the specialist does it. He opens that price, and then all of a sudden the quotes come out, then the Reg NMS rules kick in, and then there's trading, and then you figure out like where the stock price is. So for example, here we see 130.27, 2,860 shares. And right afterwards, this is the market that came out. And let's assume that right after that open, the next price is 332, right? 332, up $2, and then it just goes, right? So what we're trying to do is say, well, in essence, if I'm going to trade at the open, right, getting that opening price, and believe me, I tried doing it and stuff, it's getting in on this price, especially if you have more, would not be even realistic. Realistically, you're probably waiting for the open because you need a reference price. You could run your models, know what your risk is, know what you want to do. Is it a good buy, a bad buy? But you need a reference price, right? So up to then, you don't even have a reference price, so you don't even know what to do. And then right after the open, trading begins. So what do we do is say, the most likely, if you're going to trade at the open, is that first minute VWAP. What do I mean by first minute VWAP? We take the first minute after it opens, the stock starts trading. And there's a bunch of trades, and then there's different volumes. So we take the volume weighted average price of that first minute and say, that is the most likely price you would have. And some people use 5 minutes, right? Some people will even go out. I'm already using a minute to be closer to this opening. But most likely you're going to enter in your order. You're going to figure out where the stock actually is, and you'll be able to get filled in that first minute, right? That's, from my experience, the most, more likely than getting this opening price, this 2,860. Okay, it's when the stock actually opens, the quotes are firm, meaning you could buy and sell on the bid and offer. The other exchanges are has to be Reg NMS compliant, so they can't trade through. That's where you're most likely going to get, start getting your fills in. And so we use the first minute VWAP as the most likely open, right? That's why we use it. So you could use this, but if you're doing analysis, right? If you're doing analysis, well, where is the gap? How much does it move from the open to the close? Where can I realistically have been buying or selling? As a professional, you could look it up. Professionals don't really even reference a single price. It's usually VWAP prices, volume weighted average price over a certain time. Okay. That's usually the standard way of doing it. A single price at a moment in time, a single trade, that would be very hard to get in on every one of these single trades. So that's the opening. What about the high? So when we look at the high, we kind of want to see, well, how much does the stock extend, right? From the opening to the high, opening to the low. We might want to see, the percentage moves. We want to calculate the volatility intraday. Well, let's assume that the stock is trading around 100, 150, and then, 101. And then all of a sudden 100 shares trades at 103. 100 shares trade at 103, and then it pops back in. Officially, that's the high of the day, 103. But realistically, if only 100 shares trades at that one single price, and all the other volume is, most of it, like at $102, right? That's where the real essence of the volume is, even at the highest point. Then the 103 is like an outlier, or it's not a realistic. You're going to be overcompensating, right? You're over exaggerating the move to the upside, because the likelihood of you selling, you wouldn't be able to sell more than 100, and the likelihood of you doing 1,000 or whatever it's not there. So what we do is, again, we throw out that outlier. If it was just 100 and it was far away from that VWAP price, we just throw it out. We say that's not realistic. That's not the high. even though some other people will print it as the high. But in your analysis, it wouldn't make sense. Again, it's like the real estate situation. It's what are you trying to analyze? We take minute VWAPs, out of the minute VWAPs, we take the highest 1 minute VWAP, volume weighted average price in 1 minute. That would be our high. Same thing for the low. Any kind of outliers we take out. Any type of stocks that trade outside, let's say there's a contingent trade. So a trade that was tied to an options trade that was traded on the, like, say, CBOE, but they needed to put up stock. They put up stock, they crossed it. In actuality, that's a cross. That's not an actual trade. It was a cross to match up with an options trade. We'll take that outlier out too, because if my limit order was there, I wouldn't have gotten it anyway because it crossed, right? It was a cross from one broker to the other broker. It was predetermined ahead of time. They put it up on a regional exchange. So this is what's happening. And I get a lot of emails. Well, why isn't your averages or your implied volatility or sometimes your volume not matching up with something I see? And sometimes I get these websites I've never heard of. I get like links to, oh, this is the first, I never heard of this website. I can't explain to you what they're doing. If you told me, like, how did you get this number and stuff, I could explain. But a lot of times people want me to explain what the other people are doing. And that is something, I can't do because I can't speak. I don't know what is going on in the other systems and how they're cleaning their data, if they're cleaning their data, what they're doing with it. So I guess the questions that I had was like, why are some of the things I'm seeing not matching up? You're finding websites not matching up sometimes, and I'll check, if there's like a raw piece of data, I'll check that. But when it comes to like certain things, it's the way we clean the data. It's the way we treat outliers. It's the way we sometimes treat, like people ask me, well, what is your 90-day average volume doesn't match up with, I don't know who it was, Yahoo Finance or NASDAQ 3 months. All right, but 3 months is not the same thing as 90 business days, right? 3 months could be they're counting, calendar days with weekends and holidays. We're calculating 90 business days. When they're looking at volume, are they including broken trades in there? Are they including contingent trades in there? Are they including, these average index swap? Like, there's lots of stuff going on there. What we try to do is when we're looking at the volume, we're looking at the actual trading volume, regular volume sweeps that actually traded. We'll exclude volume that is based on something like a contingent trade or something broken, or sometimes you'll see here. Let me see if I find it here. Derivatively priced. Contingent here, bunch sold, bunch. You have all these types. Price variation, reopening. So they'll take down a trade, redo it, split trades, stop. You have all these different points, data points that you need to account for to get the essence of, well, what is the actual volume, right? What is their actual real volume if I take out, corrections, broken trades, contingent trades, right? All this stuff, if I take it out, what is the actual volume? So, we have 2 minutes left. I know it kind of went on, but again, I'm just trying to go through some questions that I see kind of reappearing.
Great job, Dima. Great job. For those who missed Jake's episode yesterday, it was a great one. It was good to see Jake back. It was great to do the show with Jake. I will put that in the link as well. Great show, Dima. Awesome job.
Thanks everyone for joining. Stay safe out there. Have a good trading day. See you guys tomorrow.